Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on November 7th. My
hmm
name is Ian Saunders, joined here by Joseph Tazula. Tuz, how's it going?
Good, good. Market's bouncing back a little bit today
Yep.
after a bit of a rough couple days. So we'll see what materializes from there. But everything's fairly quiet, I would say. We are in the seasonally strong period, and we'll get into that a little bit as well. Um, but I guess we maybe want to start off with the end of October. S&P's been up for 6 straight months. It's the 23rd time that's happened. So everybody's wondering how much longer does this rally have, you know?
Yeah. Yeah, I think it's kind of interesting. I mean, we ended, to your point, October was positive. It wasn't absurdly positive, but it was definitely strong. We saw risk on areas continue to lead throughout the month of October. Heading into October, I think there were some questions of we've been on a pretty good run. So I mean, how long is this going to last,
Yeah.
right? And October has historically, I think we have what that piece, I think we talked about it a couple pods ago, that love hate October,
hmm
where market tends to do pretty well or pretty bad, right?
Yeah.
It's not a lot of middle ground. We kind of got a little bit of middle ground this time. I mean, we
Yeah.
didn't get any major thematic shifts, kind of steady Eddie, continued higher. To your point, the S&P posted its sixth consecutive monthly gain. Doesn't happen very frequently.
hmm
Um, it's not necessarily surprising. I mean, it's a good thing. It's not like shocking to see that happen, but
Yeah.
how does the market typically kind of do after 6 months of gains? Is it good? Is it bad?
Well, it's pretty good overall
Yeah,
on the averages. I mean, usually when you look at a big enough data set, on average, the market's up most of the time
right. So it's
moving
up
forward.
20
So,
most of the time.
um, but after 6 consecutive months, you're up about 11% 1 year later on average. So pretty strong, right? Now, 1 month, 3 month, 6 month are average to slightly below average, you could say, which makes a decent amount of sense given you're on a really big run. Some froth's going to come out of the market at some point. And it's probably going to be on those shorter term time frames, and then the market will probably just kind of continue higher as long as the technical picture looks good.
Yeah, and I think it's kind of interesting. We're throwing some of these charts up there that colleague Trevor put in the report a few days ago. But in looking at a lot of times when I look at consecutive gains, right, you look at each individual instance, right? So
hmm
if the market was higher 7 months in a row, it wouldn't be counted in the 6 month bucket. I think Trevor looked at it as if it was just rolling continuously,
Yeah.
right? Which helps in the forward performance time frame because otherwise if you look at something, hey, how does it do after it's up 7 months in a row? Of course, it's going to be down the next month
Yeah.
because it's only looking at those individual instances.
Yeah.
But if you look at it in the table here, it's not as negative as I would expect, especially if we go from 6 to 7 months. If we do get another month of positive performance, you almost double your average 3 month return. It
Yeah.
goes from like 2.4 to 4% average. Now the instances drop from 23 to only 16. That's happened. So the lower amount of times that you're looking at, obviously pretty influenced by a few of those
Yeah.
periods. But I think it's interesting to note. It's something that we're getting there's a lot of communication out there around have we gone up too much? Are we in a bubble? Right? All
hmm
that fun stuff when the market rips off 6 months of gains, it's a bubble, has to be a bubble, right?
Yeah.
um, and just kind of show it doesn't necessarily have to be the case, right?
No.
Now there's all the fundamental stuff with all the AI that's out there, but looking at it from a pure performance standpoint, we've seen this before, it's not abnormal.
Yeah, it's not anything that doesn't happen like once every 50 years or anything like that.
Right, right.
We're in a strong market. Strong markets are going to put together strong market statistics that you
Right.
see historically. I don't think it's anything to get too crazy over, but it is a good talking point with clients because they're going to call in probably, or at least some of them are going to call in like, "Hey, we've been doing really well recently. Like, can we keep going?" It's like, well, you can keep going until you don't keep going is the gist. And talk about you know, keeping going until they don't keep going. We saw the our RS spread indicator reach new all-time highs, which looks at the performance between high momentum stocks versus low momentum stocks and tracks that spread of performance between those two and indexes it. And that index reached a new all-time high this month. So good looking momentum market so far this year. We have seen a few changes like financials dropping from third to fourth in the Dolly sector rankings. Technology's been pushing back up higher in there. But
hmm
overall, the general structure remains intact. from
Yeah,
a
I mean,
momentum
we've seen
standpoint.
leaders continue to lead, right? And the fact that in looking at this RS spread chart, like to your point, it's looking at the top quintile performers minus the bottom quintile. So the bigger the spread, the bigger the dispersion between the best and worst stocks, right? The fact that this is reaching highs doesn't it isn't too big of a deal. It's not like you don't want to be as concerned with like the specific level of
Yeah.
the chart because to your point, Mark, they do have a tendency to rise over time. The chart builds on itself
Hmm.
over time. But the fact that we are pushing higher is a thing is a good thing. I mean,
Yeah.
the most important thing that I like to look toward on this chart is just which direction it's moving. Is it
Hmm.
moving higher? Is it moving lower? Is momentum doing better? Is momentum maybe taking a breather? Right.
Yeah.
And when this chart's continuing to push higher, it's seeing that maybe the rotation, like you mentioned, it's happening in a relatively orderly fashion. It's
Hmm.
not like we're seeing leaders all of a sudden turn to laggards in a big day. Like we were down pretty notably. We're on this podcast Wednesday afternoon. Tuesday was a bad day for leaders.
Yeah.
We saw a decline. You saw that across a lot of sectors. Most of the major cap weighted representatives were down 2+% on the
Hmm.
day. Meanwhile, this chart did show a lower reading, but it didn't reverse down into O's.
No.
So it's saying one day is not going to change a trend, right? I mean, it's the fact that this chart's been pretty consistent. It doesn't change all the time. We're continuing to push higher. At the end of the day, it's a good thing for momentum as we head into what has historically been a pretty strong couple months for momentum, looking toward November and
Yeah,
December.
yeah. Both of these months are usually pretty good. Once you get past Thanksgiving, it turns out to be usually really good.
Yeah.
Um, so we'll see how it continues. I mean, even though some places are kind of weakening that were strong sectors like financials,
Hmm.
really it's the financials fell because regional banks had a pretty poor showing at earnings, but the big banks actually did pretty well from an earnings standpoint,
Right.
and those are the high momentum names anyway.
Right.
So we were avoiding a lot of the weaker stuff in those sectors anyway. But it's good to see that we've been in a pretty strong momentum market for the last almost 2 years now. 2023, not so much, but
Yeah.
since the end of 2023, it's been a fairly strong market from a momentum standpoint. It's
Right.
always good to see.
And I mean, we are seeing, like we mentioned with yesterday's move, um, we have seen some participation readings start to back off.
Hmm.
So if we're looking at stuff like we've seen this on an individual sector perspective, like you said, some stocks are definitely moving lower, especially in like more of the small cap oriented areas, maybe
Hmm.
backing off a bit or consolidating a bit. But when looking at like the 10-week for the S&P, TWSPX, percentage of stocks in the S&P that are trading above their 10-week or 50-day moving average are kind of near-term focused moving average
Yeah.
indicator. If this chart's high, it means that we're in kind of a breadth thrust. Markets are, or most stocks are above that
Hmm.
near-term moving average. If it's lower, hey, maybe not so much. Things are doing backing off a bit. And that's kind of what we've seen. This chart topped out, what, at 78% three different times in May, June, and July. Couldn't break higher to 80. And 80 is happens to be kind of a line in the sand for a breadth thrust classification.
Yeah.
Didn't quite get there, but then started to move lower. And now we're down at 40, right?
Yeah. And one thing that's important is we've definitely seen the breath cool off, especially from an equal weight perspective. But we've also seen the S&P has just kind of continue to march higher. Even with that weakness we saw on Tuesday, the S&P on its default chart is still on a column of X's. It hasn't even
Right.
reversed down yet. So it's important to look at the indicators. That's one piece of the puzzle. Look at the price action on the charts. It's another piece of the puzzle. Look at the relative strength rankings for asset classes, another piece of the puzzle. But once you do start to see these shorter term breadth indicators dive and kind of get down into lower and lower levels, if this gets down to like 30% and the S&P is still like hanging in there really tough, I mean, that really means that there's only a handful of stocks that are even keeping it afloat, let alone driving the returns higher.
Right.
Um, so we'll see what comes of it. I mean, the equal weight's been a laggard for a really long time. We put something in the report uh, 2 weeks ago, I think, that looked at the S&P equal weight versus the S&P cap weight on a rolling 3-year return basis, and the cap weight's outperformed the equal weight by 40%. First time it's done it since 99, 2000. Not saying that's going to have a repeat moving forward,
Not a great time.
but it's just one of those things where, that happened. The first time it happened was um, January 1999. We still had another 13, 14 months until the cap weight peaked out from its strength.
Right. Right.
So I think that's something to keep in mind. Um, but it's just kind of another indicator here showing us that the strength has been in the cap weight names.
Yeah, and I mean, in looking at this too, it would be weird to see it not oscillate a little bit back and forth.
Yeah,
This is a short-term focus indicator. It's not meant to hang around at 70 or 80 for 6 months,
no.
right? It's in a healthy, even in a healthy bullish market environment, you can look back throughout history. We won't throw up all the history on the YouTube for those that are following along, but we tend to see it go coast to coast a few times a year.
Yeah.
And it's been hanging around an upper field position, moving steadily lower isn't the end of the world. I mean, given obviously as stocks continue, just from a straight moving average math perspective,
Yeah.
stocks hang around at high levels. That moving average naturally moves higher. A little move down like Tuesday, we get it's a little bit easier for stocks to move below that average, right? And so this moving steadily lower isn't a major sign. I was looking at the tech space specifically earlier, but I think kind of calling it like, hey, maybe a little bit of a yellow light, definitely not a red light, like not a big cause for
Yeah,
concern, but
definitely.
definitely something you want to monitor because if to your point, if we see this indicator get a big wash lower, meanwhile the market's still up at relative highs, that's where you get into that potential divergence state, like Chuck
Yeah.
talked about before.
Mhm.
That could be more of a red light, but we're not there at this time.
No, and another thing to point out too is like if you look at the S&P equal weight just itself, I mean that has pretty much been sideways since September.
Hmm.
Hasn't gone anywhere. And in that scenario, if it hasn't gone anywhere in, essentially 10 weeks, you would expect about half the stocks are trading above or below their 10-week or 50-day moving average,
I
which
mean,
is
I'm just saying, if you look at chart of RSP, we won't necessarily put it up, but for looking at it, topped out at 192, double top, gives a sell signal potentially at 184, kind of a shakeout pattern.
kinda.
Could be. It could
Could
be.
be.
It could be a shakeout pattern. And I was looking at that actually, Microsoft, very similar technical picture, um, where we've seen if that moves lower, it gives a sell signal again. It could be an interesting kind of shakeout pattern. So moments like this, I think, are important. Yeah, we something else could hit the news cycle, something else could come in, something else could take the market lower. Stocks need to take a breather, right? And at the end of the day, this doesn't have to be the beginning of the end. It could just be another potential buying opportunity.
Yeah, and they've taken a breather. The average stock has taken a breather for a few months now. So
Yeah.
maybe there's fuel there where the mega caps maybe stall out for a little bit. The equal weight really starts to
Would
pick
you be
up.
more concerned if the markets had just ripped higher for 2 months than if things had consolidated for 2 months? It's a tough
Oh,
question.
like if they like, I mean, what are we talking about? Like ripped higher, like 10% in 2 months or
Just
something
kept
like
moving rather
that.
like I'd always it doesn't I kind of like seeing a little bit of consolidation,
Yeah, I do too.
right?
It
Allowing
builds up
prices to
for another
normalize.
move.
Yeah, you get some
Yeah.
support or some resistance kind of baked in there. Yeah, to your point, opens the door for another move.
Yeah, it's usually a better rotational environment for
Right.
momentum strategies than when you get like these really quick declines and stuff just like kind of falls out of some of the rankings and you end up kind of getting rid of them when you wouldn't want to get rid of them because they're about to bounce back type of deal. Usually, you see this rotation, it's a bit more mellow
Mhm.
than some other times, which can be good for, momentum strategies too, um, moving forward.
Yeah. And I mean, in looking at, I mean, momentum's doing pretty well, market's doing pretty well
Hmm.
heading into November here. But I think it's a pretty interesting year because it's not, there's a lot of stuff doing well. I mean,
Hmm.
we had gold at all-time highs, pulled back, but it had room to pull back. It had been up a lot. I
Yeah.
mean, Bitcoin pulling back a little bit, it had been at relative highs. International equity markets had also been doing pretty well and continue to do well. Maybe they're not hitting the same pace of improvement that they were earlier in the year, but they're hanging up there.
Yeah, and we've seen, from an international standpoint, emerging markets have really picked up the last couple months.
Yeah.
A much more broad picture, whereas it was developed markets were really leading the way, and they still look really good. Like
Yeah, they look better.
I still really like developed international markets right now because they've just been so consistent. Um, but, when we look at seasonality, which we touched on a little bit, we've entered that period and that's kind of lines up with our FSM model changes,
Hmm.
where we did see a lot of global and international equity kind of start to sneak in back into our models.
Yeah, and so FSM, for those that might not be familiar, we have basically two main ways of classifying models on the site. We have models that are built on strictly relative strength matrix, like you take a defined inventory, stack them all up, and see what comes out on top.
Mhm.
The FSM fund score method a little bit different, can be a little bit more flexible because those model inventories, the rankings or the scores, they're functional fund scores. Score goes from 0 to 6. 0 is the worst, 6 is the best.
Mhm.
The score is independent of the inventory. And I think that's a really unique case for these models is that if you throw in QQQ or whatever fund into an inventory, its score is going to be the same regardless of what inventory you put it in,
Yeah.
right? And so you want to make sure that when you're building out those inventories, it makes sense. And functionally, it tends to function similarly to like a matrix-based approach, but a lot of times it's easier to understand,
Yeah.
right? You simply, hey, score 0 to 6, the higher the better. It's easy for someone that's uninitiated to our stuff to understand. We have those models. Some are evaluated monthly. Take an inventory, sort it by score, pick the top end is
Mhm.
basically how those models work. Some are monthly, and then some are those seasonal quarters. You mentioned the market seasonality, the whole sell in May, come back in November type of deal.
Mhm.
Well, now it's back in November, and those models are set to, this was the last evaluation, beginning of this month, last evaluation for those FSM models this year. Um, we did see some changes. We've seen international equities start to come into those portfolios already
Mhm.
at earlier evaluations,
Yep.
right? But they took a little bit more of a focus in international equities with this most recent update, especially on like the mutual fund side of things. Is that right?
Yeah, like on our T Rowe Price model, we saw global stock, new Asia, and then we saw science and tech go in. So
But we
tech,
already had global technology in there
yeah, we
too.
already had global tech. So we have three international or global funds. I mean, with
Right,
global, you got a little bit of US in there
right,
too,
right, right.
or depending on the global fund, a lot of US. But still, you see that flavor of like all international, all US type of things going in there for T Rowe Price there. And then from the American funds standpoint, not as many changes going in, but we did see Euro Pacific growth go in,
Right.
which is still more US focused than T Rowe is.
Hmm.
But again, just another evidence point of the strength in international equities over
Yeah,
the
and
last
those two
year.
fund providers tend to present a lot of times different pictures of the
Yeah.
market. T-Row tends to be a little bit more risk on. You'll see those, and what that means is you'll see those scores move more frequently. They'll
Hmm.
get to more extreme levels or they move more frequently. Whereas American funds those scores tend to be a little steadier. So when something changes and something moves, it doesn't tend to move as quickly as maybe a T-Row does, right? You think that's fair?
No, it's definitely fair.
Like more
And
of the risk on versus a slightly not conservative, but more conservative-esque manager
yeah,
behavior.
American funds is much more conservative, at least from a diversification standpoint. They're not going to try to pick stocks like crazy. Like T. Rowe is really known on the street for their ability to kind of pick out stocks, where American funds is, something you can feel like you can lean on a long-term basis from the
Right.
diversification
Yeah, different
standpoint.
approaches, but similar changes. So I think
So
that
similar
kind of
changes.
speaks to the market environment, like we're saying.
Yeah, and one thing I did want to touch on there is like when we look at kind of our six major groups on the asset class group scores page, so you got like your core S&P 500 index funds group, that's still way at the top, right? Average score 4.9. But in second place is all global and international and diversified with an average score of 4.4. Below that, you have all US equity diversified at around 4. So, you know, if you look at developed markets or emerging markets or just ex-US markets, a lot of them are doing better than what you would expect, or you're seeing from the S&P equal weight, small cap, mid cap type of space. It's really either, the cap weighted mega cap stuff is still number one by far for the most part. And then you actually are able to pick up that global and international rather than, US small cap or US
Hmm.
mid and large on a really
There's
like
just more
equal weight
options on the
basis
table, kind of
than
globally.
there has been
And I
over the
think it's
last few
kind of
years.
interesting too, because most of those representatives that are carrying that score higher, you look at the international equity space, the vast majority of funds in international equities are cap weighted.
Hmm.
So you have a global tilt towards that kind of cap weighted space, whether
Yeah.
it's on the domestic side or whether it's on the international side. And it's some new entrants to areas of improvement on the international side. We had Europe kind of leading the way. Europe is not backed off, but just kind of consolidated. It's not showing the same level of improvement, especially on the developed side. Meanwhile, you have a lot of areas in Asia, like South Korea, rocketed higher over the course of the past several weeks.
Hmm.
Then you have South America. Colombia is now at the top of our country matrix. You have
Hmm.
Brazil tick up a bunch of spots. Taiwan's doing really well.
Hmm.
So China obviously is kind of hanging in there. Kind of an interesting dynamic of strength. We were saying a lot of times before, if international is truly going to be back, you need the emerging market space to kind of pick up the pace a little bit too.
Yeah,
Now you've had developed markets cool off a bit, emerging markets pick up. If they can both continue to push higher, I think that would be a pretty interesting dynamic to watch.
for sure, for sure, and it opens up a lot more options for asset allocation too.
Yeah.
Like you actually can feel like you can pick up international without it just like some token allocation international just because you kind of have to have it. There's actually opportunities
Yeah.
there.
A lot of those international equity areas that have shown that recent improvement, like your Colombia, like your South Korea, um, are in pretty overbought territory though. So
Hmm.
I think it'll be interesting to see if emerging markets, especially, is known for quick improvement and then quick retraction.
Yeah.
So if we can see those areas kind of hang around, that could maybe get some more room to run on the broader
Yeah,
scale.
and on the developed side, while it's cooled off a little bit, one of the things I talked about consistency, and part of that's just like on an absolute basis, but from a relative basis too, the relative rankings have been really consistent this year.
Hmm.
Um, if you look at like EFA versus kind of a universe of other more focused developed markets areas, the broad index is kind of ranking in the bottom half or even in the bottom third of those rankings this year, and it's been the case entering this year and until now. So there's just a lot of areas that are performing better than the kind of developed market benchmark, which leads to a lot of opportunities there from a dispersion standpoint.
Yeah.
Where in the U.S. market, it's really difficult to beat the Qs or the S&P cap weight
Right,
right now.
right. That's true. It's a good point of differentiation.
Hmm.
Cool. Well, I know that I'm sure there'll be a lot to hit on over the course of the next few weeks. We're pretty much through earnings season. We got Nvidia coming up in a couple weeks.
Always
Um,
later than everybody else.
Always a fun one, yeah. Nvidia, and other than that, I mean, we'll keep an eye on. I know interesting Fed decision coming up.
Yeah, we'll see what happens there. A lot of the talk the last few days has been they may hold off on another cut. It's still, I think, more likely that they cut than not.
Hmm. But it
Um,
was like a 98%
yeah, and it
chance, and
dropped to
that's backed
like
off.
70
His
or something.
percentage is always like it's good to keep up to date with what's going on, but like you can say one day it's a 98% chance. I mean, that's damn near
Like a
it's definitely
certainty.
gonna happen. Then it's like, oh, it's a 60%. What happened there? Like
Yeah.
all it took was a couple words from Powell, and that
Yeah, I mean, I would be still surprised if they decided not to cut at
yeah,
least one more time. Just based off of especially like where markets are have the 2-year yield at. They're expecting not only just a rate cut in December, but a lot more rate cuts next year too.
yeah, and I think part of it's too. I mean, Powell knows that words carry weight,
Yeah.
and so part of it may be positioning or something we'll consider.
Hmm.
Um, yeah, it'll be some fun stuff to look at as we head toward the end of the year.
Yeah, for sure.
Cool. You got anything else?
Nothing.
Okay, cool. Thanks, guys, for having me on.
Yep.
Thanks everyone for tuning in this week, and we'll be back next week with any other updates.